This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of December 17th, 2025. I'm Terry Evans, along with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. If you have any questions or want more information on any of the topics that we discussed today, please reach out to Patrick. You can find his email right below here. I'll post that right there. And of course, it's available in all of his social media links and through patrickmleonard.com. How did I cover it all, Patrick?
You do such a great job at promoting me, Terry. Thank you very much. Checks in the mail.
All right. Let's check into the markets. A little up, a little down, and kind of flat over the week. Still up 3% over the last month, 6% over the last 3 months. How are we looking as we get closer to Christmas and the New Year, when I suppose everybody is going to be doing that and then looking forward to 2026?
Yeah, I'm definitely looking forward to wrapping a ribbon on 2025 and cracking a bottle of champagne in anticipation of a good 2026. But you're right. If we look at the markets since our last podcast, the U.S. market is slightly down today. There's some job data coming out in the U.S. for October and November. And we've talked about that before because I wasn't sure if there was going to actually be any job data released for the period that the government shutdown was going on. So we're going to get that today. We expect it to be messy, but the net result is that we're expecting it to show job weakness in the U.S. And so that's likely what the markets are telegraphing today, at least for the U.S. side. Canadian market today also down a little bit, but relatively flat for the week. Gold, wow, what a ride on gold is. A couple months ago, we had seen it peak over 40 or over 4,200 US and then fall back below 4,000. And it has been marching right back and has had a really, really strong month, up about 6%. And I believe it may have set a new all-time high yesterday, again, just slightly over 4,300 US. Bitcoin, different story. While it's up slightly today at around 87,000 US, is it's really been under pressure. So lots of questions in the marketplace about, what's kind of a fair value for Bitcoin right now. I'll have to admit, in that particular space, I've never really been able to find a really strong resource that is consistent in terms of, why Bitcoin is having a strong period or a weaker period. But definitely feels like there's a disconnect between what's happening in gold and Bitcoin, and that it's going to be under pressure for a while.
What about last week? The Fed lowered their interest rate. The Bank of Canada did not. Anything of significance to report there?
Yeah, so that makes that was the third cut for the U.S. So that was definitely significant. When we think about next year with rate cuts out of the U.S., we're kind of currently sitting with this forecast that we expect 3 cuts for the U.S. next year. So the current chairman, Jerome Powell, we believe that his term is going to end right in around the halfway point of the year, around May, and then Trump is kind of putting 2 names kind of on a pedestal in terms of who his replacement will be. I think that that's going to have a big impact for rates next year in the U.S. And then I think with regards to the Bank of Canada, I believe the Bank of Canada is kind of signaling that they might be done, with where rates are at. And so I think that's very important, especially for people that have either thinking of getting a mortgage or have a mortgage renewing, is that I think people have been kind of in their minds thinking, okay, is this going to be a good period or a bad period? Am I going to have that to deal with that maturity while rates are moving lower? Right now, consensus is Bank of Canada might be done for a while, and that longer term, we need to be kind of thoughtful that we might see a rate increase longer term down the road as we watch inflation.
And of course, because of COVID 2020 and 2021, 60% of mortgages in Canada are up for renewal after a 5-year term in 2025 and 2026. I know that for a fact from my mortgage broker, Michael Thompson. So it's something that's going to keep those people hopping. As we look forward to 2026, what can we expect for Canada's economy? Is it on the up and up, or are we going to be kind of downtrodden?
So I do think we are going to enter into 2026 with a more positive outlook than we entered into 2025. Now, when we talk about the environment of opportunity for the economy, we're usually looking at a GDP forecast, so gross domestic product forecast. And so I think it'd be interesting for our listeners just to know how we make that calculation. Now, there's we get these forecasts. They tend to come out of some type of government agency or a financial institution like Bank of Montreal, which has a great economics department. And we've been doing these calculations for decades, and the models get more and more sophisticated. But the most common model is an expenditure model. And so we look at all of the inputs into a formula that basically looks at all of the spending that an economy is going to have. And so we look at things like expected consumer spending, spending on housing, government spending, business spending, and then a net exports. And from that formula, we get a gross number that we compare to a previous period. And so we're usually looking for, is the economy going to expand? So are we going to get 1 or 2% of growth, or are we going to see a retraction? Which we call recession if we get it over consecutive periods. And so if I look at the consensus that's coming out of all the banks and all the other financial firms that's coming out of the Bank of Canada, is that our expectation for GDP growth in Canada is somewhere between 1 and 1.5%. And actually, while that doesn't sound all that exciting, that's actually slightly higher than what our expectations were going into 2025. So what would be our reasons for that? Well, we have been lowering interest rates, and it does take about a year and a half after an interest rate cut for that interest rate cut to kind of percolate its way through the economy. And in this particular case, provide some incentive for people to either go out and borrow, or for businesses or government. And so we expect those lower rates to help. Canadians really did keep their elbows up in 2025, and we saw that from a lot of Buy Canada and a lot of staying here in Canada. And so, that was very positive. So as we kind of think about 2026, we expect much of the same with regards to this Buy Canada, diversifying our portfolio of export partners. So, we kind of see this happening kind of all the time. We see some other interests besides the U.S. in investing here in Canada. So, that's going to be very positive for Canada. We know that there's going to be some government spending, which we also think is going to be significant. And so this is where this positive, albeit contained, expectation is for the Canadian environment. So in general, we are optimistic about that. I would say that our concern would be we will likely see renegotiations for the U.S., Mexico, Canada trade agreement in July of 2026. So I would kind of put that as the asterisk.
And I think at the beginning of 2025, everybody was very concerned about how tariffs were going to affect the Canadian economy, especially, and whether or not there was going to be a recession. And like you said, everybody sort of dug in their heels, and it ended up not happening as badly as there were some people anticipating. What about the U.S. and the rest of the global economy and how it relates to Canada?
Yeah. So even in the context of this trade war, the U.S. continues to be our largest trading partner. So as goes the U.S., expect Canada to be very much kind of benefiting or being punished by that. And so our expectations for GDP growth in the U.S. are actually slightly higher. I'm seeing most consensus forecasts are coming out somewhere between 1.5 and 2, with most of those actually closer to 2. Like the comparable from 24 to 25, there was a lot of question marks about the U.S. economy, whether or not they were going to achieve a soft landing as they came off of very high interest rates and lower interest rates, and would they get it right? And so when we think about the opportunity for the US in 2026, I do think that there's a lot more catalysts that can be there to prop up the US economy. We're still expecting a lot of AI spending. We're expecting at least three more interest rate cuts. Now that those can always come off the table, but three interest rate cuts for the US. I still think that the benefits of the big beautiful bill in regards to tax savings and deregulation, those things are all going to be tailwinds for the US economy. I also think that this deductibility for business expense, we're doing something similar to that here in Canada. I think that's going to be very significant for the US. In the past, traditionally, if you bought a piece of machinery, you were only allowed to deduct, a portion of the spend for that piece of machinery for your business. And it was usually tied to the depreciation or the amortization of that asset. So, piece of machinery, you're going to depreciate it over 10 years. You could depreciate 10% of the cost per year. Well, now some of this big spending in the US, they can potentially depreciate they can potentially expense up to 100% of the expense in the year of the investment. So that brings the profitability of those expenses, much quicker back to the bottom line. So those are a lot of what I think are things that are really going to help the U.S. economy, and this is probably why we're coming with a forecast that's stronger. What I do think will be, for the U.S. economy is those midterms, and will those midterms perhaps put some handcuffs on the potential for the U.S. economy in 2026? We'll have to wait and see, but certainly something to watch out for.
What about risks and how it relates to how we should invest coming up in 2026?
Yeah, so I've got four kind of key risks. So hopefully I painted what I think is generally a positive picture for at least the North American economy for 2026, but there are some risks, and I think the one that stands out the most for me is inflation. And for most of my clients, if we think back to the most recent negative year for our investment strategy would have been 2022. And 2022, it was, we were dealing with high inflation and rising rates, and bad for financial assets. So inflation is hanging around. Tariffs are inflationary. U.S. inflation is above target inflation, around 3%. Canada actually, recent inflation numbers, especially the core inflation number that the Bank of Canada looks at, we're comfortable with those numbers. Still above 2, but we're comfortable enough that we're holding rates. Whereas in the U.S., a lot of this optimism about the U.S. is based on the fact that they're going to be able to continue to cut interest rates. If inflation were to rise, those interest rate cuts come off the table. So that for me, that's one. The second one would be in the credit markets. So a lot of this spending, especially this AI spending, we hear these numbers, hundreds of billions of dollars, a $50 billion deal over here, a $50 billion deal over here. Well, that spending is financed in various different ways. One of those ways is borrowing. So it's credit. And that may be public, through banks, or it may be private credit. So we got to keep an eye on the health of the credit markets because they're very intertwined. I think back to March of 2023 when Silicon Valley Bank in the United States failed. The U.S. government had to step in really quickly to contain the collateral damage because of how intertwined the credit markets are. If a bank all of a sudden has a run on deposits because of a problem that they have, all of a sudden the spotlight is highlighted on all kind of similar institutions. And then banks, they're very conservative in general. They immediately pull back and build a moat around their lending. And then all of a sudden we see capital get very restricted for a period of time. So we have to keep an eye on that. And there's been, comments in the media about that we have to be aware of credit. And so, from an investor perspective I expect that people are going to be a little bit careful about going too long dated when they're buying their fixed income instruments. So whether or not those are bonds or GICs. So I think that that's one. I also think that, we are going to see some earnings misses. That's just normal. Just like some businesses will exceed earnings expectations. We go into 2026 with some pretty good expectations around businesses, publicly traded companies in North America in terms of their earnings, for next year. But we're going to see some misses. We always do. And as we've talked about quite a bit in the podcast, is that in general, Stock prices follow fundamentals, and the biggest part of those fundamentals is positive earnings and earnings growth. And so if kind of along the way, some of this excitement, especially around AI, if we don't see the productivity gains or we don't see the monetization off of those spends, is we're going to see some earnings misses. So then the last one would be this debasement topic. So this idea that currency is losing its purchasing power. This is one of the reasons why, gold has been so strong, is that I think this is going to continue to be a theme sitting kind of up on people's shoulders or in the back seat, is protecting the purchasing power of my money. And so we have to, this may be a way for people to kind of hedge their purchasing power by, adding to things that, were the more stable valuation. I think this is, certainly something that has led, in the various type of crypto trades that are out there, especially with Bitcoin. But I think that's going to be another theme that we're going to have to continue to watch in 2026.
Very good. If you are listening to this podcast, please reach out to Patrick through his website, patrickmleonard.com. If you have any questions about the topics today or anything as far as investment insight is concerned, also follow us on Instagram at the Wealth Roundup. Also, if you want to watch on YouTube, you can do so there, and please subscribe. It's youtube.com/at the Wealth Roundup. Patrick Leonard from the Leonard Wealth Advisory Group from BMO Nesbitt Burns. Thanks very much.
Have a great week, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.